Well, the key highlight of HDFC Bank results was the sharp decline in its liquidity coverage ratio. The entire focus in the result was down to credit deposit ratio being at 110%, which is perhaps the highest in the sector, and also due to the fact that HDFC Limited book has now been merged with the bank, this ratio looks to be on the higher side. Another focus was the liquidity coverage ratio, which declined sharply to 110% versus 121% in the previous quarter. The sharp decline in liquidity coverage ratio was due to strong loan growth, for which the bank used part of the GSEC portfolio for growth. Hence, in the near term, deposit garnering is necessary and it would come in at a cost, or the bank would have to slow down on the loan growth momentum. Either ways, the most important factor to get affected is the net interest margins. HDFC Bank reported net interest income which was lower than our poll. However, thanks to sharp rise in the treasury gains which grew more than 41% quarter on quarter, the top line growth or net income as we call it, that growth was on the healthier side on a sequential basis. So what to read through HDFC Bank's number for the sector? The best of net interest margin is behind. Now, owing to rise in cost of funds, the best of return ratios is also behind, and owing to net interest margins and provisions, that is provision expected to move upwards, which means the credit cost will start moving up. Now, RBI's new risk weight asset norms will impact capitalization of many banks in Q3FY24. Banks can see sharp rise in risk weight asset to advances ratio on a sequential basis, that is on a Q-on-Q basis. Loan growth can moderate from current levels in the coming quarters as deposit growth is slowing down for the entire system. One of the reason for slower deposit growth could be perhaps that people are finding various alternates as well in lieu of keeping their money in deposits like capital market, etc. Brokerages have remained upbeat on HDFC Bank with respect to their recommendation and target prices. They say that there are two key things to monitor are the liability, ability to raise the liabilities, and that is for deposits, for growth come borrowing repayment of the borrowings that they had for HDFC Limited, and net interest margin trajectory. It is the first time that on a YOY basis in a decade that you are seeing an EPS decline. Now, disappointment in the quarter was the LDR ratio, and replacing high cost borrowings of HDFC Limited with deposits will be a long drawn process. So in their view, the improvement in net interest margin is critical for the re-rating of the stock. All the brokerages are bullish on the stock with ratings of buy, outperform, overweight, add, etc. HSBC is the only brokerage to cut the target price to 1,950 from earlier target price of 2,080. Brokerages target price now ranges from as low as 1,950 to as high as 2,200 for HDFC Bank. In the con call, management has highlighted that their lending deposit ratio can go down for several quarters to come. They don't want growth for the sake of growth, meaning to say they will not chase growth for the sake of it. They will have to replace borrowings with deposits and grow further loans with deposits as well, indicating that deposit growth is the key for HDFC Bank going ahead.